What's up guys, Hamilton here, and today I want to talk about Spirit Airlines Save. I'm sure you've all heard the joke about how to become a millionaire in the airline industry. Start as a billionaire. Fun fact, which I doubt any of you know, but I actually started my career in investment banking covering the airline industry. Now, normally I'm not into investing in airlines. I'd consider myself an airline bear. In fact, a friend of mine recently asked me about investing in airline stocks, and I suggested he look at aviation lessors instead, because it grants you exposure to the industry, but doesn't give you airline-specific risk. But last week, I was lucky enough to see Hedgeye Industrials analyst Jay Van Sciver pitch Spirit Airlines, and after doing my own research on Spirit, I was immediately sold on his investment thesis. With an airline like Spirit starting the year on a negative note, investors should be reminded of the upside potential in the beaten down airline sector. After passengers surged during the holidays to rebound highs, the reopen story is a lot more promising despite surging virus cases and more European lockdowns. I'm highly bullish on Spirit Airlines as domestic travel will dominate the rebound in the near term. And I'm going to share 3 reasons why I think Save could outperform in 2021. Let's dive in. Airlines are one of the better places to be out of a recession, at least in most prior recessions, and Spirit Airlines, the low-cost carrier, is ideally positioned for a post-pandemic travel rebound. Right now, the stock price has been beaten down by the combination of empty planes, low ticket prices, and high fixed costs. Coming out of this, it's likely we'll see the exact opposite as ticket prices go up and planes are filled with people desperate to travel again. In other words, there's significant upside in earnings potential which Wall Street seems to be ignoring. So here are 3 reasons I believe Save could be a great investment for 2022. Vaccine rollouts. As COVID-19 recedes, giving away to pent-up travel demand, while elements of pandemic life may carry on into post-pandemic life, for example working from home and reduced business travel, there are signs of substantial pent-up demand for leisure travel. And Save is a low-cost carrier that primarily services the leisure travel market.
Like Delta, American, and United make a big chunk of their revenue catering to high-paying business travelers. Ultra-low-cost airlines like Spirit target budget flyers by keeping fares low and charging passengers for services.
Higher savings in $2,000 stimmies should enable a segment of travelers to fly. Prices should gain as load factor increases and unit costs drop, leading to a rapid cyclical upswing in industry profitability. 2, its operating performance has improved and share gains continue. 3, shares may look expensive in the current climate, but this is a classic bullish cyclical setup. Spirit Airlines is projected to see revenues reach 2019 peak by mid-2022. Spirit Airlines had record sales of $1 billion back in Q2 19 and nearly repeated that amount in Q3 19. Van Sciver suggests that the airline is poised to top an $8 EPS in 2022 as traffic normalizes, which would make the stock cheap here. Add to this that Save's emissions per passenger mile are superior to that of the broader airline industry, and you could see socially conscious investors flock to invest in recovery themes. There are obviously risks relating to virus variants and political stresses, but given that the majority of Spirit's business is domestic air travel, I see this as a limited downside. The company completed a series of debt and equity offerings in the third quarter of 2020 to boost its cash to $2.1 billion. And with a daily cash burn of $2.3 million, Spirit has enough liquidity to make it through any extended travel lockdowns. Another concern is the exposure to fuel price rises, as we're seeing hefty oil price inflation in the current market. However, in comparison to its legacy competitors, Spirit has a lower fuel burn per seat and doesn't have a negative correlation to fuel prices. The traffic levels for 2021 are still unclear, but what is clear is that a large swathe of people are willing to fly despite escalating COVID case counts. Consider that traffic was down nearly 100% in April 2020. Coming out the other side of this recovery is going to be measured not in small percentage terms, but in hundreds of percentage terms. And we're already seeing some indications of travel improving. So the perception that things are gradually getting less bad will pale in comparison to absurdly high year-on-year growth figures. In other words, the optics of this stock are going to look insanely good when travel opens up, and right now investors are projecting a worst case scenario into the future despite multiple vaccines in various stages of distribution. All of this sounds great for the general airline industry, so why Spirit Airlines in particular? Well, low-cost carriers are gradually eating away at the market share of legacy airlines. In Europe, we've seen spectacular growth in LCCs like EasyJet and Ryanair that took away business from national carriers. And it's highly likely we'll see the same thing happen in the US market. We can see that Spirit Airlines is already taking away market share from incumbents, which makes it a growth and recovery play. The stock may look expensive right now, but one of the best times to buy a stock is when it looks out of favour. So to sum it all up, we have exposure to a leisure travel recovery, growing market share and a depressed valuation, making Spirit Airlines one of my favourite buys for 2021. At $30 per share, this is trading at roughly 3.5 times earnings, and here's the cherry on top. It has a 14% short interest. That's a double-digit short interest on a small cap stock trading at just over 3 times earnings. I predict that as the industry recovers, we'll see a flock of investment into the airline industry, with Spirit being a favourite. If this happens, shorts will be forced to cover, creating the right environment for a small short squeeze that will propel the stock over $40 per share. That's all for today's video. If you enjoyed it, please smash that like button. Now I need to set a disclaimer here, this is not investment advice and blah 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 yada yada yada. Also, these videos take time to make and I've been buying Spirit since $26, so if you'd like to stay on top of my investments, follow me on Twitter. That's a wrap.